Welcome to Finbot Insights. Let's get straight to it. This is a strategic briefing designed for the intelligent retail investor. So, what are the biggest threats to your portfolio? Well, it's not what you see on the news, not the market crashes or the big recessions. The real dangers are much quieter, much more persistent, and far more destructive. The enemies you're up against are your own mind, hidden fees, and the taxes you probably ignore. To get those superior returns you're after, you first have to identify these adversaries. Only then can we build a plan to take them down, systematically. All right, here's our battle plan for today. We'll start with the unseen battle. Then we'll dive into your brain, your enemy. After that, we'll expose the tyranny of fees and the inevitable tax drag. From there, we'll build a rational framework for victory and wrap up with your next move. So let's begin. The unseen battle. It's so important to frame this conflict correctly. You see, your fight isn't against the market. It's against the hidden structural forces that are quietly eating away at your ability to build wealth. And that brings us to enemy number one, your own brain. This is, without a doubt, your most formidable opponent. The entire field of behavioral finance has shown pretty conclusively that our minds are just not wired to make good financial decisions by default. You know, for the longest time, traditional finance was built on this idea that we're all rational, that we carefully look at all the information and make the best possible choice. But then behavioral finance came along and just blew that idea out of the water. It proved that our own psychology, our biases, and our emotions consistently push us toward making bad decisions. So the real battle here, it's between the perfectly rational investor you think you are and the predictably irrational person you actually are. Let's look at something called prospect theory. It really exposes a fundamental flaw in how we make decisions. Imagine this. I give you $1,000, free and clear. Now, you have a choice. Option A is a guaranteed extra $500. Option B is a 50-50 shot at winning another $1,000. What do you do? Well, most people take option A. They go for the sure thing. Okay, now let's flip that scenario on its head. This time, I give you $2,000, but now you have to choose a loss. Option A is a guaranteed loss of $500. Option B is a 50-50 chance of losing $1,000. Here's where it gets interesting. Most people suddenly become gamblers. They choose B to avoid a guaranteed loss. This is called loss aversion. The psychological pain of losing money is just so much stronger than the pleasure of an equivalent gain. And what does this lead to? It leads to investors clinging to their losing stocks for way, way too long. Next up is confirmation bias. This one is the absolute enemy of any kind of objective analysis. It's our natural tendency to go looking for information that proves we were right all along while conveniently ignoring anything that suggests we might be wrong. When you do this, your research stops being a search for the truth. It just becomes an exercise in reinforcing your own initial ideas, no matter how flawed they might be. Then you've got herd mentality. You know, sticking with the crowd was a great survival instinct out on the savannah. But in financial markets, it's a disaster waiting to happen. It's that urge to jump on the bandwagon, usually driven by a fear of missing out. This is exactly what inflates massive financial bubbles and then causes them to pop in a panic. Why? Because in the market, the consensus is very often dead wrong, especially at the extremes. And let's not forget overconfidence. This is the simple, dangerous belief that you're smarter than everyone else, that you can outwit the market. This bias leads to two classic mistakes: trading way too much and not diversifying your portfolio enough. And the data on this is overwhelming. For the vast majority of people, these behaviors are a guaranteed way to destroy value over time. Okay, let's move on from our own minds to the second enemy, the tyranny of fees. This one works in the shadows. It's a slow, quiet, corrosive drain on your money that creates a performance hurdle that, frankly, most active fund managers just can't clear. Just look at this cost difference. It's staggering. On one side, you have actively managed funds that often charge you more than 0.75%, 75 basis points. On the other, you have passive index funds that can cost less than 0.05%. That's 5 basis points. Let's be very clear. This isn't a small difference. It's a difference of an order of magnitude. Now, this chart is really telling. It tracks the performance of a high-cost active fund against a low-cost passive fund over a decade. And what do you see? The returns are almost identical. This should make you ask a very simple, very critical question. If you're not getting better performance, what exactly are you paying all those extra fees for? let's put some hard numbers on this. Take a typical passive fund. The expense ratio is practically zero, and its standard deviation, which is just a way to measure risk, is around 13.5%. Now look at the active fund. The expense ratio is nearly 30 times higher, and it's significantly more volatile, with a standard deviation close to 19%. The conclusion here isn't an opinion, it's structural. Passive funds generally offer a better deal, lower costs and lower risk. All right, that brings us to our third and final adversary, the inevitable tax drag. This is the one that so many retail investors completely forget about. But it's a huge deal because taxes directly reduce your net take-home returns. It's the money you actually get to keep that matters. Look, asset location is just as important as asset allocation. You have to put the right investments in the right accounts. Your taxable accounts, that's where you want your most tax-efficient stuff, like index funds and ETFs. Your tax-deferred accounts, like a traditional 401k, that's a great place for things that generate a lot of taxes, like actively managed funds. And finally, your tax-exempt Roth accounts, that's where you put your highest growth potential assets. Getting this right is a fundamental part of maximizing your after-tax wealth. And this strategy doesn't stop when you retire. In fact, the order you withdraw your money can make a huge difference in how long your portfolio lasts. The playbook is simple. First, spend down your taxable accounts. This lets your other accounts keep growing tax-free or tax-deferred. Next, take only what you're required to take, the RMDs, from your tax-deferred accounts. And you save your Roth accounts for last. Why? Because their growth and withdrawals are completely tax-free, and you're never forced to take money out. You want to preserve that advantage for as long as possible. Okay, we've identified the enemies. We've dissected their tactics. Now it's time to pull it all together into a single, rational framework for victory. First things first, let's dismantle a common myth, dollar cost averaging. It's often sold as this safe way to invest, but the research shows the exact opposite. As the folks at NDVR put it, it gives you a lower expected return and more uncertainty. It's, and I quote, a clear lose-lose. The math just doesn't support it. And the historical data couldn't be clearer. If you invest a lump sum of cash, you end up with more money about 2/3 of the time. If you try to drip it in with dollar cost averaging, you only come out ahead 1/3 of the time. The lesson is simple but powerful. Time in the market beats timing the market. When you have the capital, the best move is almost always to deploy it. So here it is, a rational investment framework broken down into 4 simple steps. 1. Acknowledge your biases. Know your psychological weak spots and build systems to protect yourself from them. 2. Systematically minimize your costs. Your default choice should always be low-cost passive index funds and ETFs. 3. Optimize for after-tax returns. Use that intelligent asset location strategy across all of your accounts. And finally, number 4. Commit to your strategy. Put your capital to work decisively and have the discipline to stick with your plan through the market's ups and downs. This is the logical, evidence-based path to victory. So there you have it. You've been given the intelligence. The only question that remains is this. Do you have the discipline to actually execute the plan? Because at the end of the day, the gap between knowing what to do and having great results is always, always about execution. Now, let me be perfectly clear. This is not financial advice. It's for informational purposes only. You are responsible for your own financial decisions. You need to do your own research with intellectual rigor. And you should distrust all financial influencers on the internet. And that includes me. But if you did find this strategic briefing valuable, please do like this video and subscribe for more from Finbot Insights.